Good afternoon and warm welcome to everyone who has joined us today. My name is Piyush Tiwari and I'm Professor in Property at the Faculty of Architecture, Building and Planning. Before we begin, I would like to acknowledge the traditional owners of land I'm on today, the Wurundjeri people, as well as the traditional owners of land you are situated on, and acknowledge that Indigenous Australians have been custodians of land and waterways of Australia for thousands of years. I pay my respects to their elders past, present, and emerging. As part of MSD at Home, we will discuss today a correction like no other in office markets. Few housekeeping things. Please post your questions through Q&A function on your webinar screen. We will try and take questions as they come, but if something remains unanswered, we'll try to take them towards the end if time permits. With the prospect of COVID-19 restrictions easing in Victoria, there are two key questions when it comes to where and how we work are up for debate. What changes would workplace need to ensure safe return of workers? And what is the future of existing office properties? While the answer to the first question is based on advice from public health and government, the answer to the second is still elusive. What is occupying policy discussions currently is how to get the economy and employment back on track. Part of this question is to what extent work would return to offices and what risk landlords of office buildings face in current economic climate. So far, the employment trends are positive. The growth in employment in FIRE sector, these are finance, insurance, and real estate services in Victoria, have been positive. But two sectors that have shrunk are the administrative and support services and the public administration. Though the government budget that was tabled 2 weeks ago is a pro-business budget, a lot will depend on agility of small and medium enterprises and education sector. Migration will play a key role in education sector recovery, which at present seems uncertain. Within this context, we will discuss the future of office property. We have Michael SCHUH with us. Michael is Joint Head of Valuation and Advisory Victoria for Knight Frank. He is also National Head for QA and Compliance. With 30 years of experience in a range of property market across Queensland, Victoria, and South Australia, and specialisms in major institutional and mortgage security valuation in commercial and retail sector, market review advice, advisory, and strategic services, and expert witness report. He is the most qualified person to guide us on the state of office market today. Welcome, Michael. So the format for today's discussion will be that Michael will make a brief presentation and he will take us through various terms that we use in property and how they are determined, and will also take us through where the market is at the moment and what the future looks like. Over to you, Michael.
Welcome, everyone. So, Professor, can you just go to the first slide? Okay, so I'm going to keep this to a 30 minutes of just some quick valuation theory, which then will inform the later discussion that we'll talk about, which is the new market. And this is a market like no other. I think that the number one thing is that half or more of what's happened in changing market cycles in the last 20 or 30 years has completely changed as we look forward, because we are in the middle of what is probably a 20-year deflationary era where growth is going to be limited, where we deal with disruption and AI that creates new challenges for the economy. And this means that the growth outlook that's happened in property has completely changed now. And a lot of people, even those seasoned investors, are still struggling to come to terms with that. So we'll start off with just some theoretical points on valuation, and then we'll move to the broader outlook that'll be guided by the professor. Now, as I move through this, I want you to feel free to ask questions, because some of these issues are quite complicated. They are simple, but they appear complicated, and I think, and I'll accept everyone now that, guys, valuation is not rocket science, but it just requires a bit of wisdom. So, Professor, I will make this point as well for all of you as you move in life, because I believe you're sort of in the middle of your careers or at the beginning of them, is to understand that valuations of property are points in time and are fundamentally more looking back, whereas investors are always looking forward. So there is that slight dislocation, and it's very important to understand that's the narrowness of valuation is. So sometimes a property value might be well supported by the market evidence, but that may not be its intrinsic value. It could be above or below it because they are points in time, and your role if you become an investor is to pick which time the values are above or below intrinsic value. So, all right, if we move to yield theory. Okay, just understanding a couple of differences between the capitalisation approach and the DCF approach. So the cap rate, it's important to understand that the cap rate is an intuitive analysis of all of the future outlook captured within that 1%, 6%, 5%, 4%. So it's also the cap rate for the valuers is the cap rate relative to the sales evidence. Locked up within that whole assumption is that you apply a consistent analytical approach in analysing your sales evidence to derive your cap rate and IRR. And then you apply that same approach when you move into assessing a market value. You apply the same market rent parameters relative, above and below, but you're applying a market rent, adjusting for capex in the same way, adjusting for vacancy in the same way. The minute that consistency of approach ends, the valuation becomes skewed, and this is where failures occur. So if I said to you all, another thing that's absolutely central is that your mathematical approach that you apply in deriving your market evidence and your market yields, your cap rate, your IRR, that you need to use the same approach relative for variations of quality and location, etc., in the application to assess the market value of an asset. All right, and that may be whether you're working as a valuer or working within a property trust or for a private investor. Now, if we just go to something the professor and I were talking about before, is within that discussion is often something that gets lost about the terminal yield or reversionary yield in the DCF approach. It's very central to understand that in the DCF approach, that the terminal yield is not a prediction of the cap rate in year 11. The terminal yield is simply an consistency of approach analysis where valuers at the moment, they allow 0.25% spread. So if your cap rate going in today is 6%, your cap rate in year 11 is 6.25. Now, because the NPV of your DCF, 70% of your NPV is the actual NPV of the terminal value. So things that can blow out a DCF and make it completely unreliable are inconsistent growth rate, inconsistent terminal yield relative to going in yield. Those things can create a 20 or 30% change in the terminal value, which then creates an error in the NPV and makes the DCF completely pointless. So those two things, consistent growth and consistent terminal yield assumptions, are central to getting the DCF to work as a valuation tool. Okay, a little note on historical yield hierarchy. Okay, so, and also understanding that the cap rates are a function of total return, which we'll talk about in a minute. Historically, your major regional shopping centre was at the top of the yield hierarchy because of two things. its growth was very, very high compared to other assets. It was more stable, more reliable, and less risky. So hence you can see that your terminal yield was, say, 6.25% for a major retail shopping centre. Net growth was, say, 2%, and the cap rate is a function of your total return outlook or your total return expectation and net growth. So it was 4.25%. Then if you go to, say, office, the market total return, if you just look down there, it says 6.75%. Growth was a little bit lower. Hence the cap rate for office was 5% versus the cap rate for a major regional centre was 4.25%. So I think if you go to the next slide for a minute, we'll go backwards and forwards, Professor. This is an important thing to understand about where cap rates and IRRs come from and their relationship. The number one thing is to understand is the market uses cap rates as a key discussion point and driver of value and the movement of cap rates and how that affects value, because that is the simplest analytical tool. It's actually probably the most reliable because there are the least amount of assumptions. However, all investors are total return buyers. They look at the total return, which is the sum of your income plus your capital growth, which is your actual growth rate. So IRR less growth, net growth, equals a cap rate for a property, in theory. Where this goes to, so if we just then go back, Professor, to the previous slide. So you can study this table later, but you can see that where you've got industrial historically had a higher up IRR for various reasons, which you can see in there, the investment fundamentals and investment risk, very low growth, and so its cap rate was higher, versus retail where it was less risky, higher growth, cap rate lower. So higher growth outlook, less risk, lower cap rate, and lower growth, higher risk, higher cap rate. They're the fundamentals of cap rates and IRRs. Any questions so far, Professor?
One question which probably I would like to ask is that even within retail, we see that the cap rates have ranged over 4.25 to 7%. Are the risks different, or why is that difference coming through?
All right, and this is the cap rates we're seeing right now, you're saying?
That's right. That's right.
Yeah. So what's happened now is that the hierarchy of yields has been completely turned on its head because of disruption in the retail centre. Never seen before. And so what we're seeing now is that the growth outlook in retail is probably negative. Now, it's more negative in some than others. So sub-regional now is almost become a lost asset because it sits between convenience, which is very reliable now, and is probably sitting at the top of the retail hierarchy. And regional centres, because they've got offer and scale and they've got potential to transition, the sub-regional centres now that are selling at, say, at 7 or even 8%, they're actually transitioning towards a change of use and redevelopment into alternate uses. So this is why that cap rate change has moved out. And retail, I suppose, also is possibly the most singular of assets in that you can't lump all centres into one basket. Office buildings, industrial does behave much the same because it's a homogenous asset class. So it'll move in a sector way, right? However, retail is very much time and place. It's very much what's this catchment, what's its competition, this particular centre, what is it competing with? So retail is a very unique asset class. Does that answer that question as to why? Your question was, why is the yield range so broad?
Yeah, I think, but yes, definitely you answered the question, which does explain, yes.
Yeah, okay. All right. So just moving on then to understanding that this sense of hierarchy that is a tradition in the property market has now been turned on its head. And that is all about the growth outlook and the risk to that growth and the future outlook. Industrial in, say, Sydney and Melbourne, for instance, for a long, long time, industrial had piles of supply. You could build it till the cows come home, all right? That supply is actually suddenly not there anymore. There's been huge pressure on land values. So suddenly one of the key determinants of why there was very little growth in industrial rents was the amount of supply and the homogenous product. That's now changed because the supply is gone. Logistics with online has now become a central part of the economy that wasn't there anymore. So we wait to see. This may get overblown about industrial because there still is supply, but the markets do get ahead of themselves. So we wait to see. Convenience retail as well. Before, disinterest, it was a lower class asset. Now it's reliability, the fact that, there's one thing that you can't AI really is convenience retail. There's a lot of delivery, but people will ultimately decide what they want to eat, when they want to eat it, and want to go and get it there and then, I think. So convenience retail's suddenly moved to a more reliable asset class. Okay, if we go to the next slide.
Michael, would you mind me asking one question? Is that even within office, we segment them as primary and secondary office space. So what is the distinction? Why do we call secondary as secondary? What makes them secondary or primary?
For office?
For office.
Yeah, well, certainly office, the starting point would be location. And then the next point would be the very nature of the building itself. Now, you would start with light, columns versus utility. If you have a central core with light on all four sides and no pillars, it's more efficient to fit out. You can put more people in it, even though that we'll talk about work from home and what that might mean. But it's more efficient in terms of the amount of space. And that efficiency of a floor plate, for instance, on its own, think of a triangular space versus a square space. The triangular space has areas you simply can't use or can't easily use, versus a square space is very easily fitted into boxes and offices and workstations and what have you. Well, that same idea occurs then with pillars, and is the services to one side or in the centre? All right. Then the next thing is, what's its corporate appeal? Because the corporate market for office is the driver of demand and rental growth. Now, prime office is typically 1,500 to 2,500 metre floors. All right. The minute you go below those floor plates, prime corporate tenants are not that particularly interested because it's actually inefficient. And what they're looking for is to get as many people onto a floor as they can. So you've got collaboration and all the things that they need for office to function properly. So prime office, you would say, would be location, then floor plate, quality of building. Corporate offices, because they're looking for the talent, they want to have high quality offices. The other end of the scale, if you said 500 metre floor plate, so only B-grade tenants, small tenants who don't take long leases, they come and go a lot more often, light front and back, and then also a side core, which is difficult to divide. That would be down the bottom. So light and amenity, those things. Does that answer that question?
Yes, absolutely, Michael.
Yep. Okay. So as we move through cap rate theory, it's important to understand you see a lot of cap rates being compared to bonds. That is mathematically incorrect. The cap rate is the sum of growth, the intuitive sum of growth, whereas discount rates discount the future growth. So it's discount rate or IRR, same thing, versus bonds is the correct comparison. There's a table, you can go back and have a look at this later, but this expresses why when you have inflation, bonds are naturally higher than inflation, not necessarily anymore. Then you have a premium for property. So if the bond rate's 275 plus a premium for risk, you know, if you're going to put your money in bonds, it's risk-free. If you're going to put it into property, there's investment risk. So 275 plus 3.5 is a IRR requirement for property at, say, 6.25 in that environment. Then if you say, let's take out the net rental growth, which we'll talk about in a minute, the cap rate's 4.25. That is the theory of the relationship of bonds, IRRs, and cap rates. Okay. Any questions on that? Because it can be complicated, but this starts with accepting or knowing that all investors are total return investors first. All right. So next slide. Okay, so cap rates and IRR theory, it's all about the growth, all right? And this is what I spoke to before. You can go back and read it. Professor, I'm happy for you to give this to everyone. And if someone's particularly confused, they can contact me. I don't mind. I can talk property for hours in theory. So, you know, I don't mind, okay? So very much in this page is what I just spoke to, okay? Importantly, I think also, if you said property IRRs, do they follow bonds? They don't follow it month to month because bond rates themselves are very heavily impacted by bond traders or little nuances of the market, profit taking. But if you have a falling trend over time of falling bond rates, ultimately property returns and property desired IRRs and cap rates, taking out side changes in growth, will follow that down because the cost of capital has fallen. And that's what we've seen for the last 10 years. So next slide. So what is net growth? So that's your market rent growth, which is not necessarily very important. The market growth is almost never the rental growth in the leases. So that's an important thing that sometimes people go to because it looks to be sensible. But market growth is separate to rental growth. Market growth, the growth in the leases is actually probably what might be called a market norm from time to time, and it is what lessors and lessees loosely agree that they both agree what that expectation is, but it's not always the case. Okay, so your net growth is your market rent growth less your provisions for vacancy, incentives and capex. So your DCF teases all those out in detail, but that concept of IRR less growth equals cap rate, it is the net growth we are talking about. Okay, now other important points are that the valuer is a market observer. You may end up being the market maker. So when I am advising people, and my advice to you as well, is don't let a valuation guide you necessarily on a purchase decision. Very often you've actually got to pay a little bit more to get something good because everyone else does. Everyone's bidding for a good property. You may have to lead the market sometimes, and don't let a valuation stop you from doing that. It's also important to understand that valuers are just observers and the markets are not rational. So at different times in the cycle, you have to make a decision yourself that values are either the market's behaving overly conservatively, often during a recession, or markets have got carried away. You know, and the idea is as you go through in life, you need to be open to that possibility and always be considering it. And the other thing to understand is that the lessons of the past will continue to be repeated because people who have experienced one or two downturns often grow old and leave the market, and new players come in, and they haven't seen. People often struggle to believe that a property market could fall by 20 or 30%, but it does happen. So generational memory lapse does occur, and it is often the reason why markets actually get carried away. Next slide.
Michael, can I post a couple of questions here?
Yep.
One of the question is about, since you talked about vacancy, and on the vacancy, there is a question which is asking you if there is an increased demand for sublease space in the market today, and is that going to transform that the current corporate tenants becomes some sort of landlords because they would be subleasing their space, and is that going to be a sustainable solution in the future?
Well, certainly right now, I think it's a fascinating time. So if we talk about traditionally what's happened with sublease space traditionally hasn't had a great effect on the market apart from 1990. So it's a long time ago since it's been a player in the market. The number one issue with sublease space is length of tenure. So with sublease space traditionally, when it's become available, it's often got only a few years of tenure left. So a new tenant coming into it has got no guarantee of tenure. Now, typically people don't like moving. It's expensive. And it's actually expensive to fit out. And so sublease space really only suited a very narrow sector of the market. And so it really didn't affect the broader lessor-lessee market that was at play. Sublease space also can be problematic for a landlord if it's in their building, because the landlord, when he's leasing to a tenant, is thinking about capital value. The sublessee, when he's leasing to a potential tenant, is just trying to get rid of a cost. So they don't care. That's why they'll drop their pants and do a cheap deal just to get rid of some of the costs that they're just no longer using. In this market, unusually, we have two things that we haven't had before. The first thing is tenure. So now we've got major players, banks, who have got 10 to 15 years on leases to run, who can offer 7 or 8 years. Right? So suddenly they're a competitor on the tenure front with the landlord. Secondly, it is the incentives, and we will wait to see, that the sublessees can offer to compete with the landlord. The landlord can put a 35% incentive, which can be many millions, because they've got a capital value to protect, and it forms part of their assumptions as to the ownership of the property and their budgeting, and they can afford to make that investment by giving a potential lessee 20% incentive. Does everyone understand, Professor, about 20% incentive, what it means? And yeah?
Yeah, I think, yeah.
The question that will become evident is when these subleases come on the market and when they start actually dealing with tenants, will the sublessee tenant just simply have to accept the existing fit out that's in there? See, fit outs are often very peculiar for a business. Not every fit out suits every business in the market. So typically, a new business comes in, they do their own fit out, and that's what the incentive is used. It's not that common that they simply take the fit out and use it straight away. So the lessees that are offering sublease, they do have the benefit of tenure, but will the fit out suit the new tenant? Who will pay to fix that? How will that play out in the sublease rent? It's going to be an interesting point. But if you said broadly, for the first time since 1990, there is going to be contiguous A-grade space available with tenure in the market, and that is going to compete with lessors. We wait to see how it plays out, but it's certainly a volatile time. Yes, it's a new thing.
Thank you very much, Michael.
All right.
And there's another question before we move further. What is your views on incentives? Are they necessary, and are they not just a misleading way of propping upfront rents?
Yes. Okay. well, it's a very interesting point. In the sense that it's propping up face rents, either the rent is lower on an effective basis, or the landlord gives the tenant some cash up front and gets paid back over time. So all that's happened, that wasn't that uncommon before, where there'd be a fit-out rent plus a base rent. Right? That's now moved to just be called a face rent, which is the sum of the effective rent plus the fit-out rent. All right. So what happened was that landlords and the marketplace, capital at a capitalist system, worked out that it was a more efficient use of capital for the landlord who's got a lower cost of capital. See, a going concern enterprise has got a required return of, say, 10 to 15% on its capital. A landlord's required return on their capital is about 6%. So it was more efficient for the landlord to pay for the fit-out than it was for the tenant. And it was more efficient for the tenant to receive the rental, the incentive or the cash cost of the incentive up front and then pay the landlord back over time. I think what it is that incentives have become a natural part of this market. They're a market norm. Because of what I've just explained to you, tenants will always take an incentive rather than pay for the fit-out themselves because it's a more efficient use of capital. So I don't see incentives ever leaving the market. Are they artificially propping up face rents? Yes, which is why cap rates need to be regarded as just a valuation tool. They're not the real return. Because the cap rate is the cap rate on the face rent, isn't it?
Yep.
So hidden within the cap rate, when I say it's the sum of all things, is A, the rental growth outlook, but also the negative effective incentives. This is all within that cap rate assumption. Of course, the total return, the discount rate or IRR, factors in all of those things over the term of the investment. So the IRR, the discount rate, is the real return, but the cap rate is not the real return. Interesting point, I know. Does that answer the question?
Yeah, it does.
Yeah. All right. Now, in valuation life and generally in the market, the cap rate, the capitalisation approach is certainly the most reliable methodology. And there's three reasons, and they are fewer assumptions, fewer assumptions, fewer assumptions. The DCF is very sensitive to little tweaks in growth and assumptions. So I think as you go through life and you're using the DCF, be very wary of nailing yourself to the DCF as your main method of evaluation. It is something that we've all found out over time. It's a very good comparative analysis tool. It's also a very good test of where the market's at. So if we go to the next slide. Now, that is a slide of IRRs, bonds, and the premium of IRRs to bonds. So as we spoke about before, if bonds are at 3 and the long-term property risk premium for property investment is 4, therefore IRRs should be 7. All right? Now, if we look back to 2008, which I thought I had in 2007, sorry, Professor, I meant to go back to 2007 here,
Yep.
But at the time, the premium for bonds got down to nearly 2%. So we had bonds at 6 and IRRs at 7.5. Everyone knew the market was going to tip over because it had got too hot. All right? Now, as you look at this, if you look at the yellow line at the top, this is IRRs at the end of the last, well, at the beginning, when the market corrected, they went out from, say, 7% out to 9%. and then they've been creeping down ever since. If you have a look at the red line, in the early stages, you can see 2008, 2009, your premium to bonds, property IRR premium to bonds was about 4. That was the traditional measure, all right? As bonds started to fall, IRRs reacted for property more slowly, but all the valuers knew that when that premium was going out to 5 and 6%, we all knew that cap rates would come in because total returns had to come in. And that is exactly what's happened now. Now, as you can see, bonds have fallen in the last 12 or 18 months dramatically from 2.5 down to 1. The property market at this stage has been waiting and watching to see if that fall in bonds is permanent. All right? It's now becoming the case that it's not just some sort of bond market volatility that's driven those bonds down. Those bonds are a reaction to the deflationary era. And so myself and a few of my colleagues are predicting that cap rates and property IRRs, despite this recession, are likely to come in because the cost of capital has fallen again. And if you look at that trend, the IRRs have followed that bond rate down all the way. They just react more slowly to it. All right. And the reason they react is where I go back to is that property IRRs follow the long-term trend of the cost of capital. And so it's more of a patient. Property investors tend to be more watchful and patient over time because they're making a decision for 10 years. Property is fundamentally illiquid. So property investors, unlike share investors, can't get out quickly. Hence, they're slower to react. All right, next slide. Oh, any questions so far?
I think doing fine.
Okay, so this discussion in here, you can go back and read, is really just a rehash of just what I've just said to you guys. And, you know, this is why cap rates follow IRRs, but only if the growth is consistent. So if the growth remains the same, if total return expectations fall, then ultimately cap rates fall. What becomes skewed is if growth goes the other way, then we wait to see what happens. Okay, next slide, I think. Okay, now, where are we now? Okay, firstly, the yield hierarchy has been turned on its head, as we discussed, and for the reasons that we discussed about surety of income, predictability, and the market is looking for security now more than ever. Industrial and convenience is now probably your most preferred asset class and never was. All right. This is also a recession that like we have never seen before. This is the first time that cash is not an alternative. So in a recession, capital generally gets out of riskier positions, property and shares, goes to cash. This time capital, which is now global, has nowhere to go. It's negative bond yields in Germany, 0 to 1% here. And also, if we looked at it more broadly, this bond market only has one place to go. You know, if interest rates go up, if interest rates on bonds go from 1% to 2%, you've lost half your capital. So this is the first time that there is no alternative for cash to get out of property. More importantly, I think, though, this is the first time we've gone into a recession, and this is the only lesson that we have learned from one cycle to another. This is the first time that we have banks, major employers, who that is then related to the unemployment outlook, major employers and major property owners who went into this under leveraged. Most of the time they go into this, they've borrowed up to the hilt, so they have two problems: falling property market and they're over leveraged trying to get out to follow their banking covenants. This is not happening that time. So we don't have distressed sellers, but when we have a very liquid market and we have a floor to the market. The market's very liquid. there's plenty of capital and it's looking to go into property. So it's a very unusual time. Even though the rental growth outlook is that rents may fall, I think what we're seeing is that capital markets who are buying into property now at 5% are prepared to accept that it'll be 4%. But it's better than going into cash at 0 or 1. So they're taking some capital value risk. I think also they're through this to say that the effect we've got is not long term. Now that may not be right. They may be wrong. But certainly I think that's the view is at the moment is that they think this might be a 2 or 3 year and then the market will climb out of it. That does make sense if you think about your major employers and banks not being over leveraged. So where there is capital available, recovery should happen quicker than in past recessions, which was 1990, the capital base was wiped out. There was no capital to invest to reinvigorate the economy. So it's a different time altogether. Yes, the microwave's about to go off. We're working from home. That leads us to working from home, Professor.
Yeah, no, absolutely. Yes. Can I ask you, when you mentioned about the employers and businesses, they are less leveraged, but you are talking generally in terms of the blue chip corporate. There is a big, small and medium enterprise which is struggling in this recession. We don't know the outlook.
That is true. We do have, probably Australia, its employment base is, I actually don't know the statistics if small business is actually the major employer in this country or not. It might be. But there is an issue is that your small business appears to be, I don't know that, I don't think anyone knows the stats, appears to be highly geared. There are a lot of people who are walking around with 50% debt against their house, which they use for their business. So that's okay. It's the people who are 80 and 90% geared who are in trouble. So there's an assumption people are highly geared, you read about it, but are they? I'm not so sure. You know, there are businesses that are in trouble, but are they only 20% of the businesses? We don't know that. We will see in March and June next year what it really looks like when the government, which has been propping things up artificially, moves out of, they have to cease doing it, I think, Professor. And so that is when we will find out how heavily geared small and medium enterprise is.
Yeah, I think that's.
We are at the most unknowable point at any time in our economic history. There's no question.
Yeah. So, from the investor's point of view, particularly domestic investors or the funds, do you see them repositioning their portfolios in some ways?
Well, Australia's. You mean toward Australia? Are you talking about a global sense?
No. In this context, I'm talking about Australian domestic funds.
Well, certainly at the moment, what you're seeing is almost all of the major purchases have been from overseas capital. The Australian capital seems to be sitting patient.
Right.
It's waiting, I think. There is two types of capital, you might say. There's the super funds and the big capital, you might say. And then there's your superannuants, self-managed super funds, all right? They are piling into non-bank lenders at the moment. Normally, in this point of the cycle, the non-bank lenders have got redemption issues that creates its own liquidity crisis. That's not happening. You've also got overseas capital going into pension funds, insurers who normally make money out of the share market and bonds are all moving into lending and property investment. This has never been seen before. The pension funds out of the US and Europe have got an obligation to pay returns, and that's how they make money is, you know, and they've got no alternative in cash. It's zero. So this is it. We've got new sources of capital arriving. the domestic funds here, like I'm not so close to it, I'm just an observer of where the capital's coming from. I don't know what the other capital is doing per se, but it's not active at the moment in the property market. Self-managed super funds, the private capital though, is active, and it's in private lenders. And there's a huge amount of purchasing going on of small investors, from 2 million to 20 million, and that market's very buoyant. They're buying into property like it's no tomorrow.
Yep. And Australian assets are still the favorites of global investors. And what could be the reasons that, despite that, the whole global economy is poised to contract by almost 4.5% this year, but still there's an active.
Yes, I wouldn't say we're the favourite, but we're certainly a source of interest that is certainly gathered a lot of pace in the last 5 to 10 years. There's 3 key reasons. One is political stability. If you look across a whole lot of other countries, even the United States, we've got political stability, the envy of the world. Even if we get rid of a prime minister every couple of years, generally the rule of law is very predictable. Planning outcomes are very predictable. Sources of supply, and also we would be the most transparent market in the world, certainly apart from the UK. Market transparency, because of the privacy laws in the United States, is actually not that great. Whereas here, we have a culture of being transparent about transactions and sharing of information. It is an open economy, an open data economy in the property area in a lot of ways. And the investors can get confidence that they are buying in. Other markets, Asia, it's very difficult to get exact information and independent information that's verifiable. So we've got a very transparent information market. It's very important.
Yeah. And do you think that given the new norms that we might see coming up, something like social distancing and all this other stuff, so would the prime office buildings and secondary office building need to reposition themselves in some way?
Certainly what happens in markets, and this is something to understand, that there are certain things that happen in every cycle. One is that the secondary market will be hit worst and is always the last to recover because it's secondary. So tenants in soft markets gravitate into better premises because it's cheaper. The gap closes from the top down. So even if all the market rents are falling, the top of the market tends to move closer to capture those tenants at the bottom in competition, and even your lower tenants will move up into better buildings. Okay, so your secondary market, that means that secondary assets, there is always a yield trap at the beginning of a recession that yields in secondary investments look fantastic, but what's underlying them is the risk to that income. This is the first time we've had an income recession that we're facing. That didn't happen. We didn't have an income recession in 2006-07. The economy, people's wages, market rents generally were stable. This time, all of these things are at risk. So I'd say to anyone when they're looking at investing, valuations, cap rates, you can get them a little bit wrong and there's no car crash. If you get the income wrong, that is where you have the big, capital disasters. It's getting the income wrong, the market income wrong. So the secondary market will recover last and you'll be waiting at the end. Some secondary assets will, during this cycle, unpredictably transfer from a change of use. So some of them can't get it right. Certainly what's going to happen now is the focus on technology means that building technology, they'll have to invest in building technology. Right? I can't tell you exactly what that is, but that will be at the forefront. And some buildings can certainly move with the new requirements of tenants. It's not hard to have greater space. Does everyone know about the density issue and what's happened over the last decade, Professor?
Maybe it would be worth revisiting that discussion as well.
Okay, so what's happened is that, and this is about hub and spoke and work from home. How are we going for time? I have plenty of time. The last 10 or 15 years, the CBD in Melbourne and Sydney received a sugar hit, regardless of an increase in actual white-collar worker population and population growth that drove the economy. And we probably need to talk about population growth at some point. But is that once upon a time, your average density in an office was 20 square metres per person. Now, that was before workstations. Workstations are a relatively new idea. There was offices, and once you allowed meeting rooms, it was about 20 square metres. At the end of this cycle, that had got down to between 8 and 10 square metres per person. All right. At the same time, there was a change or an acceptance within the corporate market that the idea of having a suburban office, say one in Essendon, one in Mulgrave, one in the north, one in the far east or far west, wasn't efficient. And that was really about the need for collaboration, I think. So what happened was, over the last 15 years, they have discovered Melbourne is unique in its public transport system in that you can get to the city from any suburb, anywhere. Whereas if you're in Mulgrave, because of the traffic issues, if you're an officer in Mulgrave, you can't employ anyone who doesn't live in the southeast. You can't employ anyone from the north or the west because they just can't get to work. So the city, this has happened over the last 10 or 15 years, became the central place for corporate business, then St Kilda Road and then the CBD fringe. They all fed off that idea. Now, as we move into it, the expectation is that office densities are going to increase because of a pandemic concern and a future-proofing of future pandemics. So, it's not a short-term thing. I think big business is going to decide that you can't have everyone in cheek by jowl because we don't know when the next pandemic's going to come from. So this might go on for 5 or 10 years before they start to increase densities again. So this trend of going to the city and putting everyone in one place. There is in the market right now some belief that they'll move back to the hub and spoke, which is what it's called, to have offices in different areas because of this concern of having everyone in one place. But what's being forgotten is that the reason they wanted to get everyone in one place is immensely inefficient to have 5 different offices in 5 different suburbs. That I don't think has changed. And I think if we have work from home, and that's accepted, that will happen, they will still want to have all of the team congregating in the same place. What we found out, particularly in Melbourne, is, for instance, Zoom is all well and good and it's efficient at some levels, but ultimately humanity needs to be face-to-face. So I think work from home will happen. I don't think hub and spoke will happen because if 5 different offices in 5 different suburbs didn't work 10 years ago, it's not going to work today. When you want your people collaborating, if they're only going to work together for 3 days a week, you will still want them in the same place. So I think the CBD will go through its period of ructions with subleases and it's part of a natural volatility to that market. But I think the CBD will retain its ultimate place. That does assume, Professor, we find a vaccine.
Yeah, that's true. And hopefully we would soon, but not later.
If we don't, it won't just be property's got a problem.
Yeah, that's right.
Yeah.
One question, which is again an important one in the current context, particularly for Melbourne, where a lot of CBD space is occupied by education sector. And we recently saw one transaction where one of the leading universities, they sold their space. Do you think that given that migration is an issue, given that we have seen falling student numbers because international students are not arriving, is that going to change the dynamics in the CBD?
Well, I think, firstly, I'll take everyone back to capitalisation and perpetuity. This is what you're saying is possibly an unwise short-term reaction without taking looking longer at property and its ownership. And once you sell it, it's hard to get it back again as well. I'm starting from the point that we will find a vaccine. if we don't find a vaccine, I'm starting from the point that we will learn somehow to live with it, and ultimately all pandemics end. It might take 3 or 4 years, but they all end one way or another. The migration issue, if you look at what the federal government has said, they have said that to pay back the debts that they're incurring now, that they will use economic growth rather than increase taxes. And if they increase taxes, that sort of falls in on itself on sort of in terms of domestic demand. They'll use economic growth. There can't be economic growth in Australia without migration as we currently see it. Not without wages growth and IR. You know, AI, for instance, affects wages growth because it actually replaces employment, doesn't it?
Yep.
So this is why we're in a deflationary era. So I think that the government's going to solve the population issue. I think we are going to populate. If you look at our economy and if you look at the way that we've handled it, we will have to be one of the top migration destinations for people from right around the world as a preferred location. And the fact we're multicultural and accepting, there's a lot of things that make it very attractive to come here. And also, if you say, you know, an aggressive China, what's going on in Hong Kong, culturally, particularly Melbourne's got a very attractive place. And all they've got to do really is quarantine the people for 2 weeks and confirm they don't have the virus. Yeah. So I think that ultimately the government is going to work out a way to solve the population migration problem and that we will see population growth back. But for the next 2 years at least, which is what Treasury is forecasting, and I think it's Treasury that's maybe looked into it most deeply, they're saying very little population growth, and that is going to affect our economy more than we know.
Yeah. And you did mention the other day that the US and most cities in the US have had hardly any population growth for many, many years now.
It's the population growth that Australia is used to is globally unusual.
Yeah.
You know, and population growth is a huge driver of economic growth.
Yeah. So when you look at the economy today and the budget that was proposed 2 weeks ago, it seemed very pro-business budget. What do you think? Pro-business budget. What do you think would be necessary to take the economy to the levels where we would expect it to be for normalcy to return?
In the budget?
In the budget, from the policy point of view?
Probably wading into territory. You know, this is for anyone who becomes an expert witness. Don't get drawn into areas where it's not your area of expertise.
Right. Okay. Well, that's good.
So I could speculate, but it'd be pointless. I don't really have a fix on it, I suppose. Yeah. I think that the government's support of making sure that people don't get thrown out of their homes and to keep the going concerns alive until we can open out the economy has been the single most important thing, because once going concerns stop trading, it's very hard to get them going again. So long as they're, like, I am a believer in enforcing the rent relief requirements that they've put in there, because it does the landlords no good at all. They won't find another tenant easily. And some landlords don't manage the whole giving a tenant rent relief very well. They need to have it imposed upon them. I think it's very important that going concern was kept going.
Yeah, that's really true. And we are also observing, particularly in the retail context, that some of the landlords are in fact assisting their tenants because they are struggling. They are capitalizing them so that they stay afloat.
Mm-hmm. They've realised if they lose a tenant, they may not find another one.
Right.
It's far easier to restart and open those doors with existing fit out and a few extra staff and a lower rent. And everyone's hoping that there'll be a spike. You know, once, and it may be. I'm not a believer in a J-shaped recovery, but I am a believer in a J-shaped spike to expenditure and behaviour. Yeah.
Right. I think that's very optimistic, and thank you very much, Michael, for sharing your insights on the office market and generally the property market. It was indeed a pleasure to listen to you, and thank you very much. I would also like to thank everyone who has joined us today. And before that, We'll also talk a couple of minutes about some of the events that are coming in next few days. The first one is another MSD at home event, which will look at Copenhagen, Danish housing, ensuring life quality for many. This will be hosted by Professor Alan Perd on 22nd October. Next one is on 27th October. This is Amid.09 on other cosmologies. This is hosted by Leire Asensio Villoria and David Ma. There is another event on 29th of October. Charles Waldenham, he will talk about new heliomorphism, which will be hosted by Leire Asensio Villoria and David Ma. On 29th, in the evening, we'll hear Jane Randall speak about recent cultural projects at Zaha Hadid Architect. This is hosted by Helen Fisher. So please do stay tuned in and join in for these events. And we'll look forward to see you again. Thank you very much, Michael. Thanks for your time.
Okay.